Good afternoon, everybody. I'm unmuting everybody as I go through this here. We got some background noise. Huh?
Hello from Rhode Island.
How you doing?
Doing good.
Good. All right. Some of you have self-muted. That's fine. I'm gonna mute, but I was gonna open it up real quickly first to anyone who had any questions to start off here. So. All right. Welcome, welcome, welcome. All right. Property and casualty basics. For those of you that don't know me, I do have sample test questions and additional material. If you want to register for my material, you can go to lgdstudy.com. There's a PayPal link. You don't have to have PayPal. You can use any credit card. There's my cell phone number if you do have questions, and some people have called. And I do dedicate some time. I'm committed to having people pass this exam, so I do make time available for them as best as I can. Okay. You can also email me at lauren@lgdconsulting.com. Again, anytime you need clarification, a little more information, don't hesitate to reach out. Sometimes I am teaching other classes, so I can't pick up, but leave a message and I'll get back to you as soon as I can. All right. So we're going to dive in here. And again, this is going to look familiar. Just the title of this test or this exam you're taking is the property and casualty, or sometimes called the fire and casualty exam. Right? Fire and property are interchangeable. Sometimes your test will say it's a fire loss. Sometimes it'll say it's a property loss. A homeowner's policy is a fire policy. A homeowner's policy is also a property policy. Okay, but when you think of the property side, think of your stuff like your house, your car, your belongings. In a contract, that would be you and yours. So we, the insurance company, are going to cover you and your stuff. So you, the insured, are what we call the first party to a contract. At the bottom left, as you can see, the insurance company is the second party. So just from going from insured to insurer, you can change one word, right? The D to an R or the R to a D, and it changes the question. So you got to pay attention to what they're asking. Like concealment is neglect of the insured, which is the client. Insurers don't conceal. Insurance companies, insurers, or agents may misrepresent, but they don't conceal. Only the client conceals information. All right. So on the right side, we have the casualty side, and the casualty protects against a number of occurrences. And the biggest part of casualty coverage would be liability. And so think of you damage their house, you damage their car, you damage or injure them themselves as individuals, right? So them and theirs in a contract, right? So you and yours is the first party. We or us will be the insurance company. And for liability, we're going to cover in case you damage them or their stuff, all right? So whenever you hear liability, think L for liability, think L for lawsuit, because liability protects against lawsuits. So pay attention to that. Okay. And always, as you're reading the questions, as you go through the exams, is it my stuff that suffered a loss, or did I damage someone else or someone else's property or injure someone else? That would be the liability. So remember, property covers your stuff, liability covers their stuff. Don't mix it up. You can't sue yourself for everything you already own. As far as market terminology, insurance, you'll probably get this question 2 or 3 times on your exam as far as the definition of insurance. The first thing you need to know is insurance is a contract. It is a contract to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. I mean, that's the ultimate definition of insurance. All right. So it's a contract to indemnify, which is part of indemnity, the next line here. Indemnity means to restore you to what you had before a loss. So again, you have a 3-bedroom, 2-bath house. It's destroyed by a fire. If you have the proper contract in place, the insurance company covers the cost to rebuild the exact same 3-bedroom, 2-bath house that you had before the fire. Okay. Again, we're just going to restore what you had. We're not going to give you any bonuses like some extra skylights and things like that. Okay, because that would be a gain. So insurance is designed to indemnify you because you suffered a loss. Now, in order for the loss to be covered, it's got to be based on an uncertain future event. All right. So if you had an auto accident yesterday, you're buying a policy today to cover it, it ain't going to happen because that's a certain loss. All right. So the loss must be uncertain. Now, in order for you to buy a policy on someone, you have to have this fourth item, insurable interest. And in the property and casualty world, you actually have to prove insurable interest twice. Number one, at the date of application, which you might see at the time of the sale, or when the policy goes into effect. You see, there's a couple different ways of saying the same thing. And so your test does go a bit crazy with that thesaurus, so be wary of that. All right. You have to have insurable interest at the date of application or at the time of the sale of the policy. All right. And you also have to prove insurable interest at the time of the loss in order to collect. So if you bought a house and you insured it, 6 months later, the market value doubled and you sold it, but you paid annual premium on a home policy. That means 6 months into the policy, you sell the property. 3 months after that, you file a claim. You can't collect because at the time of that loss, you don't own the house anymore. So you don't have insurable interest. Right? The company will refund the unused portion of the premium, but you couldn't collect on that loss because you don't have insurable interest on the property. It's not yours. Another thing about insurable interest is expectant or contingent interest. Even though you're expecting to inherit a house from a great grandfather, you can't buy a policy on the house until you actually own it. That means if you did buy a house because you're expecting an inheritance, the house burns down, legally you can't collect because it's not even your house. All right, so be wary of things like that. All right, the test throws a little, some curves, some stories here, try and throw you off. So you're expecting, well, you should be, because if the house burns down and you wouldn't be able to have the house anymore. Now, but grandfather owns a house, and so the grandfather can collect, but you can't. Risk. Risk is defined as uncertainty of a loss. So be wary of that. You're going to see the key word there is uncertainty of a loss, or words, I should say. All right. There's two types of risk. We have speculative risk and we have pure risk. Speculative risk, think of gambling. All right. When you're gambling, you could lose money, you could win money. Now, if you can get a gain, the insurance company won't issue the policy. Or if they do issue the policy, they'll limit what you can collect because you cannot get a gain out of insurance. Remember, it's a contract of indemnity. It's just to restore you to what you had. That means we cover the loss. That's why pure risk is insurable, speculative risk is not. So pure risk coincides with what we want to accomplish is covering the loss only. Now, in covering that loss, there's a couple ways of managing that risk. We have retain. Retention of risk means you don't even buy insurance. Right? That means if a loss occurs, you're just going to pay for everything out of pocket. To be honest with you, the only time that you really want to retain risk is when the worst case scenario is known and you can afford it. Right? And that's where retention would come into play. So let's say they passed a law that said the maximum you would ever have to pay for an auto accident is $1,000. That means, okay, so the worst case scenario is known, $1,000, and you could afford $1,000. That means you would never buy insurance. Right? Well, number one, they'll never pass a law like that. All right. So, so knowing you don't know what you could lose, maybe you want to do something else. Okay. Now, another more subtle way of retention of risk is raising your deductible. So by having a higher deductible, the insurance company doesn't have to deal with smaller claims, and so they save money and they pass the savings on to you with reduced premium. So higher deductibles give you lower premium. Lower deductibles, well, that means you're going to file a bunch of small claims. That means your premiums are going to be higher because the insurance company has to deal with that. All right. So again, that's retention of risk. Either don't buy insurance or increasing your deductible. Right? Reduction of risk is putting mechanisms in place to reduce the likelihood of a loss. Right? Now, a loss may still occur, but you're reducing the likelihood. Setting up burglar alarms around your house, right? Smoke alarms, things like that. Okay. Exercising regularly, eating proper food, so you reduce the risk of major medical problems and possible early death. Right? That's where that comes into play. Avoiding risk, don't engage in it. So you like skydiving, scuba diving, and you just got a family. And so to be around to watch them grow up, you're going to avoid engaging in the high risk activities where you could possibly die. Okay. That's avoidance of risk. But the most practical way that we're going to take and talk about, and that's what our course is about, is to transfer the risk. Right? Transferring risk by paying a small known amount of money called premium for a large uncertain amount of loss called a claim. Now, when you transfer the risk, there's two ways of transferring. All right. Scratch that. Transfer risk is buying the insurance, I should say. Okay. Now, when you buy the insurance, now we have this other aspect called sharing the risk. All right. Sharing the risk that you transferred. And so we have reinsurance and then we have coinsurance. And a lot of people get these mixed up. And so, again, I want to expand on that. So let's start with reinsurance. So you bought insurance with a company. Let's say you want a $2 million policy with a particular company, and the company you're talking to, they're called the primary insurer, or sometimes called the ceding company. This is the original company that's dealing with you, the client, when you buy insurance. All right. Now that client has what's called a retention limit. That retention limit is based on a maximum amount of risk that they can handle for any one policy. And so Department of Insurance sets the retention limit for that insurance company. So based on your paid-in capital, your surplus, and your reserves, the Department of Insurance says, we'll give you a $500,000 retention limit. I'm plucking this number out of a tree just for illustrative purposes here in this training, okay? Just so you know. So, all right, so based on your company situation, your insurance company can write anybody and everybody up to a $500,000 face amount policy. Not a problem. All right. But if a customer comes in and they want more, this company can't cover beyond $500,000. And so now they have to share the risk with other companies. And this is what the reinsurance is all about. Okay. So when you're going to insure in excess of your retention limit, we're going to pass that to reinsurance companies. Now, the ceding company, the primary company, has agreements already in place. This is called a reinsurance agreement or reinsurance treaty. So when a customer walks in the door, they already know, which company is going to help share that risk, right? So let me explain. Again, you wanted a $2 million policy. The original company can only handle a $500,000. And so they're going to share the other $1.5 million with, in this case, 3 other companies. Then we'll have them each share it equally, a $500,000 each, okay? So between 4 companies, a $500,000 per risk per company, your $2 million risk is covered. How's that? The crazy thing about this is the only company that exists is that primary insurer, the original company. You didn't know that your insurance company that you bought a policy from shared that risk with 3 other companies behind the scenes. You don't know that. Now, if you ever suffer loss, the ceding or primary company pays the claim. All right. Now, this is called specific or facultative reinsurance because each company specifically chooses a portion of the risk. We'll get into that. Let's say this client suffered a $700,000 loss. They're going to file a claim with the ceding company. The ceding company pays the full $700,000 after they investigate the claim. Now, unfortunately, that's $200,000 over their retention limit, and so we're going to actually have to collect $200,000 from Company A. All right, because remember the loss was $700,000. We're on the hook for $500,000. $200,000 we got to pull from Company A. Now, Company B and Company C still get premium for the risk, but they haven't paid anything. Now, Company A, even though all 4 of these companies have a $500,000 worth of risk, the primary company, the ceding company, gets the highest amount of premium for this risk, even though they're all the same amount of risk. The ceding company, the original company, is more likely to pay a claim than Company A, B, and C behind the scenes. All right. So Company A gets more premium than Company B. Company B gets more premium than Company C. Company C doesn't get a lot of premium for the risk. What that means is our client would pretty much have to suffer a total loss for Company C to pay. That's pretty unlikely in most cases, right? But it does happen. All right. So if our client suffers a total loss, the ceding company pays the full $2 million, and then they get the $1.5 million behind the scenes reimbursed later on. Okay. And so by sharing the risk through the industry, it reduces the exposure for any one company. So, especially like a major loss like this picture here, this building. I mean, if one company had to foot the bill for that, it could really put a dent in their company's reserves, and they might go insolvent, which is going bankrupt. Right. So by sharing the risk, it reduces the impact and spreads it among multiple companies. So not one company takes a gigantic hit. Okay. Now, coinsurance, reinsurance deals with getting the policy on the books and sharing the risk as we're placing it on the books. Coinsurance is dealing with the claim. You got to get this coinsurance equation down. The amount of insurance you did carry divided by what you should carry times the loss equals how much the company will pay on a claim minus any possible deductible. Sometimes the question will give you a deductible, sometimes it won't. Okay. So the did is how much coverage you actually bought. The should is whatever's required by the insurance company. And in most cases on the exams, the insurance company requires that you carry 80% of coverage to the value of the building. I'm going to explain that in a minute. The loss, of course, is, well, how much did you suffer as far as damages? Right? And again, there may or may not be a deductible listed. They'll either give you a deductible, which a lot of times I've seen $1,000. But if you ever see standard deductible, that's $250. But if it's a business owner policy, the standard deductible is $500. And so these are the different deductibles depending on the coverages, right? But again, a lot of times the test says $1,000 deductible, or it might just say disregard the deductible. All right, so let's put this into practice, which I do have this on the webinar, but I still want to, go through it. So an apartment house is worth $500,000. The owner insures it for $300,000. The policy has an 80% coinsurance clause. There's a $200,000 loss. How much will the insurer pay? And so we have these numbers, and we don't know. Well, let's just plug in the numbers. So what they did have is 300, because that's what it says. They should have had 400. So even though the value of the building is 500, there's an 80% coinsurance, and so the company says you only need to cover 80% of the value of the building. The loss is stated, 200,000. All right. There's no deductible stated. So all we do is plug it in the equation. What you did have was 300,000 divided by what you should have had is 400,000. We take that, we multiply it by the loss of 200,000, and that's going to tell you how much the policy will pay on the claim. Okay. So worst case scenario, maybe 2-3 math questions on most exams. Not a lot. So you're not going to fail the test because you don't know math. It's going to be other areas. That's why I'm expanding this particular section. Okay, so don't be afraid. Usually, when you take your test, if there's a computer, there's a drop-down calculator on the screen that you can access. If not, some locations they give you like a 4-function calculator to use. You can't bring your own, just so you know. All right. So what determines a premium? Well, in any given situation, we have to pull out this pure rate. So let's say we have a 35-year-old female living in a particular area, a particular town, right? That drives a 2018 Honda Accord. I'm just pulling random stuff. Did you know in this area, 35-year-old female in this part of town with this car, every insurance company charges the exact same rate, and that's called the pure rate. All right. The second component for your premium is interest. Okay, so since you pay premiums in advance, the insurance company earns interest on your money, and we have to credit that interest to you. So we take this pure rate minus the interest that we're going to project we're going to earn on your money because you pay in advance. Now, every insurance company starts off with the same rate, that pure rate. But once we flip over to investing that pure rate, that premium, that portion of premium, I should say, every insurance company invests differently. And so the rate has now changed. Then we're going to add in the expenses, which is our overhead costs, our rent, our utilities, our employees' compensation, and acquisition costs, which is what it costs to put the policy on the books. Every insurance company's expenses are slightly different also. And so the pure rate minus interest plus expenses equals the gross premium. And that's where you have the big swing as far as what you see in the commercials. Hey, you switch over to us, we'll save you $400. But if you switch over to us, we'll save you $200. Average. I know. How come if you can't keep switching, it doesn't become free? But you got to understand the three factors. The pure rate, every company pulls that typically from the insurance services offices, the ISO. The interest and expense portion is very different from every insurance company because they all invest and have different expenses. Okay, expenses is sometimes called the load or loading. So if you ever see that, think of expenses. In blue here, a portion of every premium that the insurance company collects is placed in a reserve account. That money grows and earns interest, and that's what's used to cover current and future expected losses. And so reserves are actually liabilities to an insurance company. Most people think of reserves as assets. No, to an insurance company, it's a liability. This is the money we're going to use to pay claims. This is the money that we're obligated to pay if our customer suffers a loss. So obligation means it's a liability. All right. So your equations here, you have the pure rate minus interest plus expenses equals the gross premium. If I take pure rate minus interest without expenses, that's called the net premium. But another way you might see it on the test is net premium plus expenses is gross premium. Okay, so you got to be wary of the test. It doesn't give you the pure rate minus interest plus expenses. It might just give you net premium plus expenses, which is the same thing as gross premium. Again, the test is a bit tricky. Anything to get you pay a retest fee, I tell you. All right, solvency. Okay, to be solvent, the insurance company has to maintain minimum capital, surplus, right, and reserves, which we already know are liabilities. So a very common test question is when an insurance company only has enough money to cover its liabilities, including reinsurance, it is said to be what? Well, if you only have your liabilities, well, then you don't have capital and surplus. And if you don't have all three, you're said to be insolvent. Okay. So if a company goes insolvent, the Department of Insurance will contact the Guarantee Association. Now, here in California, it's called the CIGA, California Insurance Guarantee Association. Each state may have a different name for that, but it's kind of like when you drive by a bank, member FDIC, which is insurance on the banks if they go bankrupt, and we're protecting the policyholders' accounts of up to $250,000 per account. In California, I'm using California numbers here. Check with your state's guidelines because it might be slightly different. If your company goes bankrupt when you suffer loss, the minimum claim you can even request is $100. Anything less than that, you might as well just write off. But the maximum that they'll pay if the insurance company goes bankrupt when you suffer loss is $500,000 per claim. So if you had that $2 million property that we talked about earlier, and your company goes bankrupt when your building burns down, the maximum you're going to get is $500,000 from the Guarantee Association to rebuild. I guess $500,000 is better than nothing, right? But that's what the Guarantee Association is all about. Please understand in advertising, marketing, and selling your products, you cannot use the existence of the Guarantee Association as an enticement or an inducement for the sale or purchase of a policy. You cannot say, hey, you should buy from our company because if we go bankrupt, you're covered. Okay. Well, as you can see, in your state's guidelines might be slightly different. You're not fully covered. You may not be fully covered, I should say. Okay. So it's kind of misleading. And another thing, every insurance company that's admitted to do business in your state is required to pay into the Guarantee Association and required to be a member. Okay, so you can't say, hey, our company's, you should buy from our company because if we go bankrupt, you're protected with a Guarantee Association. Well, you're making like your company special, and it's not because every insurance company that's admitted has to be a member. Right? So don't be misleading. Give full disclosure. Right? All right, contract versus policy. This is on the webinar, but I do want to elaborate on this. A contract, which is a contract in general. And to be honest with you, contracts in general don't have to be in writing, but insurance contracts have to be in writing because it's an unequal distribution. So the parts of a contract, I use CLAC, right? The first letters there. Consideration. The consideration is defined as an exchange of value. Clients give two things of value. Number one, they pay premium. Number two, they provide personal information. The company has to give something of value back, and what the company gives is a promise. We promise to pay should you suffer loss according to the terms of our contract. That's what consideration is. That's our exchange of value. It's an act for a promise. Okay. Now you purchase a policy. The legal purpose or legal objectives of this contract is to protect against a loss. That's what legal purpose means, to protect against a loss. But instead of saying protect against a loss, your exam might say legal purpose means to not get a gain. So it's kind of two ways of saying the same thing. Protecting against a loss is the same as you're not getting a gain. Okay, that's a contract of indemnity. But again, your test goes a little crazy with the thesaurus, so purpose and objectives are interchangeable. All right. In order to have a contract, we have to have agreement. That means someone makes the offer. Usually, it's the insurance company through the agent trying to convince you to buy the policy. The client accepts that offer, saying, you're right, I do need a policy. Right? I'll go ahead and fill out the application, pay the premium, and then what they're presenting is a counteroffer back to the insurance company. Here's the information you requested. Can you insure me at what you put in your proposal? Right? And so the insurance company accepts this counteroffer and says, well, yeah, we can insure you, but you got a speeding ticket. And so in accepting this, we're going to have to charge you a higher premium. Do you still want the contract? And it doesn't matter who makes the offer because it could go back and forth. When both parties agree to the conditions in the contract, that's when we have agreement. Okay. The fourth item here, you got to deal with competent parties, and that's people in their right mind. Right? Again, use your best judgment. If they seem intoxicated, under the influence, you don't want to write them. You cannot insure a minor. They cannot be legally dead, or dead, I should say. They got to be mentally competent. So again, use your best judgment. All right. Now, parts of a policy is a little bit different. Parts of a policy, we have the declaration page or deck sheet, declarations page, right? It's the first page of the policy. It tells you who the insurance company is and kind of summarizes the coverages and usually states the premium associated with that policy. The insuring agreement for the test just tells you what type or what kind of policy you bought. It's usually part of the deck page, right, that you bought a personal auto policy. Right? So insuring agreement, and again, you might see insuring clause. Your test goes crazy with the thesaurus, so it's the same thing. Right? Just tells you the type or kind of policy you bought. All right. The conditions clause or conditions agreement basically details the duties that you have to comply with in order to collect from a loss. So if a loss occurs, the client has to notify the insurance company they suffered a loss. They're going to have to submit proof of loss to the insurance company, and the insurance company has to investigate, settle, and then pay the claim. Okay, so it spells out your duties and rights or obligations of each party. Okay? And exclusions is quite simple; it just tells you what the policy will not cover. All right? Catastrophic losses, wear and tear, intentional acts not covered. All right, now you notice conditions is part of a policy, but the conditions is not part of a contract. See, agreement, conditions is built in the agreement. Didn't we agree to conditions? Okay. So, but conditions is not its own separate element as part of a contract. Be aware of that. Okay. Which of the following is not a part of a contract? And if you see conditions, that's the one you want because that's not part of a contract. It's part of a policy. Some other areas of additional information in a policy, of course, at the bottom right-hand corner, we have definitions. So you know, it defines the insured contract. It defines who you and yours is versus we or us. It defines bodily injury, property damage, what have you. Okay. And of course, sometimes you have some endorsements, additional charge for additional features and benefits. Kind of like when you buy a new car, you get the stock car, and then for a slight additional charge, we can add the window tint, the undercarriage coating, and things like that for additional charge. So that's parts of a policy. As far as your insurance companies, there's a couple items you need to know here. The location. Where did your company domicile? Where did your company originally set up, open up shop, and get incorporated in? So depending on the state you're in, like I'm here in California, that means if an insurance company originated or organized in the state of California, to me, they're a domestic insurer. If your insurance company originated outside the state of California, right, let's say Rhode Island, well, to me, you would be a foreign insurer. And if your insurance company originated or organized outside the jurisdiction of the United States, that would be an alien insurer. So domestic is within your state, foreign is outside of your state, and alien is outside the country. Okay. Now, it doesn't matter where you're from, where your insurance company originated from. In order for them to openly, actively sell in your state, they have to obtain something called a certificate of authority. Okay. It's basically your insurance company has to have a license to transact in your state. Okay. So New York Life, which is a foreign insurer to me here in California, okay, they're admitted to do business in California because they've filed and have a certificate of authority to be able to transact in our state. Okay. So, but let's say New York Life, they have so much business on the East Coast, they don't care to apply and pay fees to get approval to sell in our state. So they would still be foreign. They would just be non-admitted because they did not get approval to openly, actively sell in our state. Okay. And again, so location, domestic, foreign, alien versus approval or non-approval. Okay, they're two different topics. But the test will try to blend them to confuse you. Like a foreign insurer is one that originated outside the state and must be admitted. True or false? Well, that's false because you can be foreign and not admitted. You see? So you got to watch out for those questions. Okay. Yeah, two different topics, but again, the test will blend them together to confuse you. All right. Now, as far as getting into insurance companies or insurers, we have stock and mutual companies, which are the largest ones. A lot of times you'll see them listed as commercial insurers. So, in order to set up a company, you got to raise money. So, in a mutual company, you raise money by selling policies. So, mutual companies offer participating policies. If you buy a policy, if the company makes a profit, they're going to give that profit to you in the form of a non taxable dividend. Dividends are never, 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 never guaranteed, by the way. Okay. So, but since you're a policyholder in a mutual company, in a sense, you have ownership in the company. So, if we make a profit, we give that profit back to you. We call it a dividend, but it's non taxable because it's actually defined as a return of excess premium paid. Okay. Now, your biggest competitor is a stock insurance company on the right hand side. So, a stock company raises capital by selling stock, which is pieces of ownership in the company. They're going to offer non-participating policies because if you bought a policy from a stock company, you do not participate in the dividends. See, if the stock company makes a profit, that profit is shared with the investors, which are the shareholders. Yeah, we're going to call it a dividend. It's going to be paid to them, but to them, it's investment return. Therefore, it's taxable. Okay. So whenever you see participating, think mutual. Whenever you see non-participating, think stock. Now, at the bottom left, if a mutual company wants to transition over to a stock company, that's called demutualization. But I've been told on the test that there's a rare question where a stock company transitions or turns into a mutual company, and this is known as what? Mutualization, which is on the bottom right-hand corner. Okay. So usually mutual companies may go public and go stock. Very few times would it go from stock to mutual, but it's a test. So get the concepts down. Some other types of insurers, right? Fraternal. Whenever you hear fraternal, think of nonprofit. Right? Businesses that engage in charitable or benevolent activities, and so all the profits actually go to the members. Okay, usually as a return in the form of benefits or increased coverage. Okay, but look for charitable or benevolent. Think of nonprofit. Okay, Lutheran Brotherhood, Knights of Columbus, right? Woodman's Group. There's a couple of fraternal insurers. Okay. Reciprocal or inter-insurance exchange. There's a couple of key words here. The first one is unincorporated. So whenever you hear reciprocal, look for unincorporated. Right? The best way to describe this is think of a homeowners association. If you live in this area, you bought a house, well, there's an association because we have a shared clubhouse and a pool, and so you're going to have to pay homeowners association dues. And everyone pays dues into their own individual account. Now, if there's a loss over by our swimming pool at the clubhouse, someone's injured and they sue, well, we all have to pitch in to help cover that. And that's called an assessment. All right. Now, in your association, you voted for a board of directors to make decisions regarding the situation. Okay. Well, reciprocal works the same way, but instead of paying dues, everyone pays premium. Okay. So everyone pays premium in their own account. And instead of a board of directors, you'd vote for an attorney, in fact. Okay. Kind of like a board of directors, they make decisions on which claims we're going to cover, which ones we're not going to cover. Okay. And so those are some key words. Whenever you see reciprocal, look for unincorporated, look for attorney, in fact. Those are some key words. Okay. It is sometimes called an insurance exchange. And honestly, if you read that backwards, we're exchanging insurance among ourselves. That means we're insuring each other. That'd be the reciprocal. Okay. Lloyd's of London is an insurer, but it is not an insurance company. It's basically a rich kid's playground. All right, we got a big old warehouse in London, England, and there's full of cubicles. There's about 150 different syndicates that wealthy people can just jump into. Right? And then they actually enter into contracts themselves. It's where people just get together and insure each other. Lloyd's just provides a meeting place for these people, buyers and sellers of insurance to get together. Right? It's one of the oldest insurers, not the oldest. Give you some history on Lloyd's of London. They originally started off as a coffee shop, just like Starbucks. Okay, you had merchant marines just kind of hang out, talk some shop, and eventually they started hanging these contracts on the wall, saying this ship with this cargo is going to this port, and if you wanted to accept some of the risk, you just sign your name under that contract. Now, if that ship made it to port and they sold the goods, you got a piece of the profit. But if that ship didn't make it to port and they lost those goods, you and everyone else who signed their name under that contract would have to pitch in and help pay for the claim or the loss. Okay. This is where the term underwriter came about. See, by signing your name under the contract, you're accepting risk. Okay. And Lloyd's is one of the oldest insurers, not the oldest, but one of them. And that's how they started. And they've grown to be basically worldwide. And they pick up stuff that nobody else wants to touch. Okay. So, yeah, you'll hear about them. But remember, they're an insurer, but they are not an insurance company. They basically just provide a physical location for buyers and sellers of insurance to get together. Risk retention group, again, where we have quite a few individuals or entities that just getting together and insuring risk. Okay, more for liability, and they just keep it among themselves. A bit of a rich kids type of thing. And then we have the government. The government is an insurer. They're not an insurance company, but they are an insurer. At the state level, we have workers' compensation that can be provided by the state government. Okay, um, you have Medicaid or Medi-Cal, which is health care for medically needy, medically indigent people, and it's actually the state and federal government working together to provide that program. Your Social Security payroll taxes at 7.65% that comes out of your paycheck, that's your premium for the government Social Security insurance program, okay? Which gives you basically survivors, retirement, disability, and Medicare benefits because you paid into it by paying taxes. So the government is an insurer. They're not an insurance company, but they are an insurer, okay? Parts of the insurance company, the actuarial department. These are your statisticians. These are the number crunchers. These are the people that research all the statistical data and sets the rates for the underwriters to charge. They have to make sure that they charge enough to cover their losses, cover their expenses, right? But they can't overcharge where they're gouging the consumer because the Department of Insurance won't allow that. And so their job realistically is to keep the insurance company financially sound, right, or financially stable by charging the right premium for the risk. The underwriting department is a risk selection process. The underwriter gathers as much information to determine should we insure this, and if so, what should we charge? Okay, and as an agent, you folks are field underwriters. You're the eyes and ears of the insurance company. You're the first line of defense that the insurance company faces. I always say, and when you're out in the field, if you wouldn't eat at that restaurant because it's not safe, unsanitary, whatever, then don't insure it. Okay. So, I mean, keep it that way. The underwriter's job and your job is to protect the insurance company from adverse selection. Probably 2 to 3 questions just on that topic. Adverse selection exists when you have a bunch of high risk people trying to seek and get insurance coverage more often than a normal risk would. All right. So someone who's in the middle of brush fire country, all of a sudden there's a brush fire heading towards their house. Now they want to buy insurance. That's too late. We're not going to insure that because we insure that when the fire is already on the way to the house. We're more likely to pay a claim. That's kind of a certain loss too. And so the underwriter's job and your job is kind of weed that out so that the company doesn't lose excessive money on things like that. Okay. This will come up. Someone who got into an auto accident yesterday and they're trying to buy an auto policy today to cover it. Okay, you can't. Okay. Marketing and sales is responsible for, believe it or not, marketing and sales. Some of your questions are actually that simple, that straightforward, that easy. But when you get test anxiety and stress, you don't even read that it's that easy. Okay. Yeah. Marketing and sales division of an insurance company is responsible for which of the following? And A says marketing and sales. And you're like, no, it can't be that easy. It's got to be something else. Maybe it's claims. No, it's that easy, folks. Okay. So if you're feeling stressed when you take your test, kind of lean back, take a deep breath, relax a little bit, and then take another look at the question. Okay. Yeah, you got to be well rested going into this test because when you're rested, you're more relaxed, you make better decisions, and that's what you want. If you're stressed, you make some bad choices. So, this is just a test. Relax. It's passable. You met people that have passed it, and they've passed it. Then you've got a good shot of passing it too. So, just to give you a heads up. Okay. Claims, that's where we investigate, settle, and pay claims. Now, we have adjusters that help out with that situation. Number one, if you see insurance adjuster, that's typically an employee of an insurance company, and they're going to deal with a claim. And I don't know, I guess from a distance, it sounds like the insurance adjuster, since they represent the company, they're going to try to play the claim down, save some money for the insurance company. And then the public insurance adjuster definitely represents the public. They represent the client in the claims process. And of course, they're going to want to play the claim up to get more money for the client. Okay. Realistically, it's like a 5 to 10% difference between what the public insurance adjuster gets versus the insurance adjuster. Okay. Maybe the public insurance adjuster will get like 5 to 10% more than the insurance adjuster, but the public adjuster charges between 10 to 15% of the claim. So, um, yeah, just so you know. Insurance adjusters are typically an employee of an insurance company. Public insurance adjuster is an independent. Okay, so valuation. If you suffer loss, how will your policy pay on the claim? All right. So we have replacement costs. That means to replace it, restore, rebuild, reconstruct, brand new. All right. So if your house burns down, it was a 3-bedroom, 2-bath house, we're going to rebuild it to be a 3-bedroom, 2-bath house just like it was. Okay. That's what replacement cost is. And typically for your property policies, your home, your dwelling, your business owner policies, we're going to cover that structure, the real property, on a replacement cost basis. Now, all your stuff in the property, we're going to cover on an actual cash value basis. That means your clothes, your furniture, your pots and pans, your TV. We're going to depreciate it. So what does it cost to buy that TV brand new today, minus depreciation because you've had it for a while? Okay. So that's what that's about. Okay. Now, if you take replacement cost without depreciation, then it's still replacement cost. That's kind of a tricky question because a lot of people, you get in that habit. Whenever I see depreciation, the answer is actual cash value. But then you get this question that says replacement cost without the deduction for depreciation. Well, then it's still replacement cost. All right. So you got to be careful. Don't just, I understand keywords are crucial. They're helpful, but sometimes you got to watch what's attached to that keyword. Okay. Market values, if you were to sell it, like if you totaled your car, where you grab a newspaper, find 3 people selling the same car as the one you just totaled, take the high, the low, the mid, we average it out. That's what we'll pay. Okay. And stated value or valued policies, we're going to pay actual cash value on the loss up to the stated value that's usually set when the policy goes on the books. Right. So we need appraisals, and then the insurance company and the insured may haggle a little bit sometimes, right? Because a lot of times a consumer adds a little sentimental value to it. Okay. But the insurance companies, we don't really care about sentimental value, unfortunately. Okay. So that's not really the factor. So we'll pay actual cash value up to the stated value of the property. Right. So again, think of fine arts, antique cars, stuff that if there's damage to it, you can't replace it because like an antique car, they don't even make those parts anymore. All right. Licenses. The one we're talking about is the property and casualty, or remember, fire and casualty. It's interchangeable. And so we have insurance agents, insurance brokers, insurance solicitors. Okay. It doesn't say property and casualty, it doesn't say life in the name. That means it's the property and casualty side. Now, on the right side of this chart, I have the life and health side. We have a life agent, sometimes called the life, accident, and health agent, right? And we have a life and disability insurance analyst, which is like a fee-based consultant on the life and health side. Now, it does say life in the name. So if it says life in the name, that's the other license. If it doesn't say life in the name, then that's the property and casualty side, like insurance agent, insurance broker. See, this is kind of tricky because in the real world, if I roam around aimlessly and people say, hey, what do you do for a living? I say, I sell life insurance. And they say, oh, so you're an insurance agent. Yeah, you can call me that. In the real world, you can call me whatever you want. Just buy my policy and I'm happy. Right? In the test world, that would actually be wrong. I'm a life agent. Insurance agents do auto, homeowners, commercial. You got to keep them separate. Likewise, brokers transact property and casualty coverage. Brokers cannot transact life and health. Now, the reason I have insurance solicitor in blue is because an insurance solicitor represents a broker agent on the property and casualty side. There's no such thing as a life solicitor. Right? An insurance solicitor is a natural person. A natural person is an individual human being, just like you and I. An insurance agent or insurance broker is a person. That means an insurance agent can actually be a partnership, a corporation, a business trust. An insurance broker can be a person, a natural person, right? It could be a partnership, a corporation, a business trust, a limited liability company. So a person is any legal entity, but an insurance solicitor is a natural person, which is a single individual human being. All right, so be wary of that. Now, these licenses we have here um, allow you to do business with admitted insurance companies. Now, when admitted means the ones we talked about, they have a certificate of authority. All right, they're able to transact insurance in our state. All right? Now, if you get unusual risk, then you might want to get your excess or surplus lines broker's license, all right, or special line surplus lines broker's licenses. These are unique licenses that allow you to place business with non-admitted companies. So what that means is, let's say you're working with a company, they sell workers' comp, which is great. You write all the workers' comp you want, but this one particular business owner, they have a munitions depot. That means they build bombs. Your company likes workers' comp, but they're not going to insure a bomb building factory. But this business owner has to have coverage for that business. And so if you have a surplus lines broker's license, you can place it with a non-admitted company, let's just say like Lloyd's of London. Okay. So, yeah, other areas for that. Okay. All right. Now, managing general agent at the bottom right-hand corner. Okay. This can be on the life or the fire and casualty side, just to give you a heads up. Okay. Um, Managing general agent is they're contracted by an insurance company, and their job is to hire agents, train agents, terminate those agents if they don't produce. Okay. So they hire an agent, agent sells a policy, brings in the application with a premium to the MGA, managing general agent. The managing general agent proofs it, signs it, sends it to the insurance company. Okay. And then the insurance company pays the agent commission, but the managing general agent also gets a piece of that commission. Okay. Remember, I hired, I trained them, right? I get a piece of everything they sell. Nobody works for free, right? If you work for free, we call that a hobby. All right, just so you know. All right. Okay. Actually, let me stop here. I notice I'm missing out. Some people have some questions. I was going to wait till the end to have a transcript. To be honest with you, I don't have a transcript. I am going to record this and post it. Okay. Yeah, I just put this together, and I'm actually just going off the cuff and explaining this as I go along. So, but it is going to be recorded. It will be posted by tomorrow evening. You'll be able to access and go back and forth on this. All right. All right. Cool. 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 Agents versus brokers. I know this is in my other webinar, but again, an insurance agent represents a company. Their job is to sell insurance to the public, whereas brokers represent the client and place business with, but not on behalf of an insurance company. Agents, when you sell the policy, you get commission. Brokers, well, when you place business for that client, you charge a fee. Right? And so between agents and brokers, agents sell insurance, brokers do not. Okay, so don't mix them up. All right. Okay. All right. Some other terms to know. Representation. That means if I sit with someone and ask them, "Hey, how you doing?" and they say, "Yeah, I'm doing fine," they gave me a representation. All statements on an application are representations. So they told me verbally, which attests as oral. I put it in writing. The client says they feel fine. The client says they had no tickets or accidents in the past 3 years. I write that down. It's still a representation. So a representation, the third bullet, is defined as the best knowledge and belief of the party offering the information. Okay? A representation as to the future is called a promise. Right? Both parties make representations. Right? The clients are representing, saying, "Well, yeah, I'm a good driver, right?" And the promise the insurance company makes is we promise to pay if you suffer loss in the future. Okay, that's kind of what that's about. A representation needs to agree with its assertions or stipulations. If a representation does not agree with its assertions or stipulations, it is said to be false. Okay. That was kind of a weird one. You can go crazy with a thesaurus, but just know if a representation agrees with its assertions and stipulations, it's good. If a representation fails to agree with the assertions and stipulations, it is said to be false. All right. Now, your clients can actually change what they say before the insurance goes into effect, not afterwards. Okay. So the last item, instead of saying what I just said, is a representation may be altered or withdrawn before the contract goes into effect, but not afterwards. Okay. Now, warranty carries more weight in insurance, and we have express and implied warranties. Now, whenever you see the word express in insurance, it means in writing. Whenever you see implied, it means not in writing. Not verbal, just not in writing. Okay? So express means, well, if you suffer loss in your car, we're going to pay the damages. That's express. Implied is, well, how'd you suffer loss? That you fell asleep and rolled off the embankment. It doesn't say you have to specifically fall asleep and roll off an embankment, but if there's loss to your car, it's covered. Okay? So implied would be assumed under the contract, is how you want to know that. A warranty is defined as a statement of fact that must be the exact truth. And the last item there, it does carry the most weight or the most clout in insurance. Okay. Statement of fact versus the best knowledge and belief. Okay. So warranties carry more weight than a representation. All right. Some other definitions. Adhesion. Adhesion, think of adhesive tape. We, the insurance company, print the contract. And since we print the contract, we're stuck to the terminology we use in our contract. So if this contract is unclear, the key word you might see is ambiguous, which means general or vague. It's the insurance company's fault, and the insurance company has to pay. Let me explain that in a story. Let's say you lived in New Orleans. You lived below sea level next to the levee. Uh, in that area, you trusted the Army Corps of Engineers that that levee's solid, it ain't going to go anywhere, and so you didn't buy flood insurance. Along comes Hurricane Katrina, which basically pushes through the levee and floods the area, and you lost everything you own. And so we're going to look at your homeowner's policy, and it says flood is specifically excluded, and so you file a claim, and they're going to reject it. But then you talk to some attorneys and you talk to all the other homeowners that lost their homes, and they're like, "Come on, there's got to be something done about this." And so we look up the definition of flood. Now, the flood is the accumulation of water over at least a 2-acre area of water of land. All right, so at least a 2-acre area of water, accumulation of water. That means it rained, it kind of piled on itself, and the water rose. Okay, but this wasn't caused by that. This was caused by a storm that pushed the water. So it was actually water driven by wind or wave. So now when we're sitting in the courts, okay, saying that this is a water driven by wind or wave loss, and so we look at the policy. It says flood is excluded. It doesn't say water driven by wind or wave is an exclusion. So the contract was unclear. So basically the policyholders got paid out on that one. Okay. Again, if the contract is unclear, the clients are going to win in a lawsuit. Okay. I got to be honest with you that after that situation, if you take a look at your homeowner's policy today and you look at your exclusions and limitations, you think water driven by wind or wave is now an exclusion in your contract? Sure it is, because insurance companies paid a lot out on those claims and they don't want to pay for those anymore. And so now in future contracts, they become exclusions or limitations. Aleatory. Aleatory means an unequal distribution. What that means is you may get more or less than what you paid for. All right. So it's an unequal distribution. Now, what that means is we have someone, they go to an auto dealership, they buy a brand new car. In order to drive the car off the lot, they got to have insurance. So they meet up with an insurance agent who sets them up with a policy. They fill out the application and pay the first month's premium of, let's just say, $100. So the agent binds the coverage, gives them a binder. This customer with this binder in possession hops in their new, convertible, right? Waves to everybody as they drive off the lot. They're so happy looking back, waving at everybody. They drive right across the street and drive right into the building across the street and total their brand new car. Now, they paid $100, and with a binder, they've got a full replacement vehicle. Okay, so did they get more than what they paid for in a contract? Sure they did. They paid $100 and got a full value of a replacement vehicle. So does that bother the agent that sold them that policy? Yeah, because their loss ratios went up. Does it bother an insurance company that happened? No. So even though this person paid one premium, got a full payout of a brand new car, don't we have thousands of policyholders that'll pay premiums the rest of their lives, and a lot of them will never, ever, ever file a claim? So didn't they get less than what they paid for in a contract? See, that's what aleatory means. It's an unequal distribution. You may get more or less than what you paid for. Okay. Insurance is a conditional contract because conditions have to be met. You do have to suffer loss in order for you to collect from the contract, from the policy. Okay. That's pretty simple. Law of large numbers. Keep it simple. You measure the past to predict the future. So I'm going to go with in San Francisco County, on average, there are two small fires every day. Okay. Those small fires, that means no more than one third of the value of the property is destroyed. Now, that doesn't mean we have two small fires every day. No, we have a week where nothing happens, and then one day, 20 homes burn to the ground. But over the long run, if we average it out, it equates to two small fires every day. So knowing that, insurance companies know how much premium to charge in this area to collect enough money for reserves to cover losses in that area. That's the law of large numbers. You measure the past to predict the future. Now, you can only predict expected losses in the future. You cannot predict individual loss. All right, keep that in mind. And you measure the past to predict the future. You don't predict the past. You don't measure the future. You got to watch the terminology. Okay. And remember, you cannot predict individual loss. Okay. Insurance is a personal contract. That's between it means it's between the insured, the client, the first party, and the insurer, the company, the second party. So insurance is a two-party contract. That's what a personal contract means. Okay. Subrogation. You'll get this definition probably two or three times on your test also, just like insurance. Mm. A one-word definition for subrogation would be substitution. So let's say you have a house, you have a homeowner's policy, and someone without insurance loses control in rain and drives through your living room. Well, you can sue them, and you're going to win because clearly their car is parked in your living room. Well, when you go to sue them, well, it comes up that they got a part-time job at McDonald's. It's a beat-up used car that's already paid for that the parents gave to them as they kicked them out of the house. Being a part-time worker at McDonald's, when you sue him, the judge awards him, well, he's going to pay you $50 a month until the debt is paid. Now, at $50 a month, because that's all they have because they don't have insurance, how many months and years of $50 a month do you got to save up to basically put a deposit on a contractor to rebuild your house? It's like a long time. So you have a homeowner's policy. And if you take a closer look, one of the perils in your policy is vehicles. And a vehicle damaged your house. That means you pay your deductible. Your insurance company covers the cost to rebuild your house, and you go on about your life. And you transfer the claim rights to the insurance company so that the insurance company can deal with that uninsured motorist. All right. So subrogation, we're going to cover the cost of the claim, and then we, the insurance company, take over the claim and collect from the responsible party. All right. When you get into bonds, bonds are subrogation contracts. We front the claim and then we take over, so you go on about your business. Unilateral. Most contracts are bilateral. Promise for a promise, right? I promise to help you move, and you're promising to give me some pizza and beer. It's an even exchange. Insurance contracts are unilateral. They're one-sided. That means typically once we, the insurance company, issue the policy, the insured simply controls it by paying the premium. Right? The client can cancel out anytime they want during this contract. The company can only cancel out if they have a legitimate reason, like possible fraud or non-payment of premium. Okay, so once we, the company, issue the policy, the client now controls it by simply paying the premium. So it's unilateral, uni meaning one, lateral meaning sided. Okay, so even though there's two parties to a contract, it's a one-sided contract between those two parties. Okay. Utmost good faith. If I ask someone how they feel and they tell me they feel fine, I trust them. I trust that they're feeling fine. I have no reason to think that they would lie to me in selling insurance to them. Right? Likewise, when I present information about the contracts, they're trusting that what I'm saying is true and correct. So when you are dealing with the public, you're trusting each other in what you're saying to each other. That's what we call utmost good faith. I trust you, you trust me. Otherwise, we wouldn't be doing business together. Now, I keep it real simple like that. I trust you, you trust me. But that's way too simple for your exam. Your exam defines utmost good faith as we are going to rely on the representations of either party without any attempts to conceal or deceive. Okay. That's awesome how they word that, right? That means I trust you, you trust me. Otherwise, we wouldn't be doing business together. Okay. Let's jump into some cause of loss forms. Perils. Perils are defined as a cause of a loss. All right. You know the common perils: standard fire policies, fire, lightning, and removal. Dwelling policy basic form, or DP1, is fire, lightning, internal explosion. And so it's a named peril policy. The named peril coverages, we have basic, broad, and earthquake. On the commercial property policy, earthquake can actually be a cause of loss form added to your commercial property policy. And then we have open peril, which is also called all risk or the special form. Right? So named perils list perils we cover. Open peril or all risk list perils we exclude. Okay, so the named peril is very limited. You can only list so many items that you're going to cover. The open peril or all risk is very, very comprehensive because you can only list so many exclusions. And if it's not on the exclusion list, it's covered. So peril is defined as a cause of loss. All right. So a cause of loss form is a form that lists perils. Just read it backwards. All right. Some people get tripped up by that. All right. Basic, broad, and special are typically the cause of loss forms, but for commercial property, we throw an earthquake. It's a named peril form. All right. Now, a hazard is a condition that would increase the likelihood of a peril or a loss occurring. So there's different types of hazards, like a physical hazard. That would be badly worn tires on your car, which means you're more likely to suffer or get into an accident. The accident would be the peril. The badly worn tires would be the physical hazard that increases the likelihood of an accident occurring. There's other types of hazards. Moral. Remember, moral ends with an L, and the L is for lie. People will lie, cheat, and be dishonest. All right, hate to say it, but it is true. And then morale ends in ale. So morale hazard is someone who's careless, reckless, indifferent attitude is what the test will typically use. Okay. Someone who engages in high risk hobbies, skydiving, scuba diving, auto racing, bungee jumping, spelunking, helicopter skiing. Okay. They're risk takers. That means it doesn't matter that you're a conservative Republican, you go to church every Sunday. If you go skydiving, you're putting your life at risk. And typically how you do one thing is how you do everything. So if you go skydiving, let's take a look at your credit report. Probably don't pay your bills on time. I look at your motor vehicle report. You got a speeding ticket or two. So it tells me a little bit about your personality. Okay, and that's what insurance companies use in the underwriting process. Legal hazards are those people that are going for more money than they're legally entitled to. All right. And that happens, dragging their feet on a claim, trying to collect more disability income, all right, claiming soft tissue damage in a 5-mile-an-hour stop and go traffic bump, trying to sue for $2 million for soft tissue damage. I mean, things like that happen, and that costs the insurance company more money in claims because they have to defend it or offer settlements, which means that increases our premiums because we ultimately pay for that stuff. Okay, so those are hazards, right? Perils and hazards. Now, how perils interact. Concurrent causation. You have two perils that work together. Let's say one is covered, one's not. Both are covered under concurrent causation. So let's go back to a dwelling policy basic form. A DP1 covers fire, lightning, and internal explosion. And that's basically it. So let's say lightning strikes the house, lightning causes fire, and then the firefighters come out and they put billions of gallons of water on the fire to put the fire out, but they've also included and added water loss, water damage. Okay. Now, fire, lightning, internal explosion are the three perils. I don't see water damage as one of those perils. But lightning caused the fire. The fire, in order to put the fire out, we did water damage. So you have two perils act in tandem, fire and water damage. They work together. Okay, so even though one is covered, fire, one is not, water damage, since they work together, both are going to be covered. That's what concurrent causation is about. Now, the other side is we have a concurrent causation exclusion. So again, we have two perils acting in tandem, right? One is covered, but now one is specifically excluded. In this case, neither would be covered. Let me explain. You have a homeowner's policy. Let's go with an HO5, right? It's a special form. It's our flagship homeowner's policy. One of the perils is collapse. That's actually a covered peril, all right? Well, lo and behold, an earthquake rumbles through, causing your house to collapse. Okay, so collapse is the peril that's covered, but earthquake is specifically excluded. So now these two perils act in tandem. One is covered, one specifically excluded. Neither will be covered. Okay, it's a little bit tricky to get this one down, but through repetition, you'll pick it up. The only exception is your homeowner's policy is a property policy, which is also called a fire policy. That means it doesn't matter how your house was damaged. If your house was damaged by fire or explosion, it's covered. Okay, it doesn't matter the cause. That means if earthquake causes your house to collapse, snaps a gas line, causes an explosion and a fire, your homeowner's policy will actually percentage off and cover the fire and explosion percentage. The earthquake portion will not be covered, but the fire and explosion piece will be covered. Okay, so understand, even if flood causes fire and explosion, the fire and explosion portion of the claim will actually be covered, but not the flood percentage. And so the claims adjusters come in and assess the damage on that. Okay. So now that's regarding perils. Now let's talk about the actual coverages. So let's say you have two policies on a building, and we have concurrent and non-concurrent. So concurrent means you have two policies that have exactly the same coverage. So you have two broad form policies on the building, right? And since the coverages are the same, they're both going to share on a percentage on the loss. Okay, that's concurrent coverage. Non-concurrent is if you have two policies on a structure. All right, one in this case is broad form, one is a special form, so the perils don't exactly match. So in this case, one of the policies will be primary and the other policy will be secondary or excess. So another way of understanding this is similar coverages prorate and different coverages pay primary and excess. Okay. So, all right. Tort law. A tort is a legal wrong. And you'll get a tort is a legal wrong other than crime or breach of contract. So tort law doesn't include criminal law, and tort law does not include breach of contract. Those are different areas of law. Now, negligence makes up the biggest area of tort law. So negligence is failure to do what a reasonable and prudent person would do in a given situation. Okay. So your house is on fire. First thing you do is get your family out, then call 911, then try and protect and preserve the property from any further loss without endangering yourself. And you don't. You just stand there and watch it burn, and your neighbors are filming you just standing there, not even trying. Okay. That may hinder your claim as far as the insurance company, right? But they have to prove you were negligent. So to prove you're negligent, there's a couple of things that need to exist. Number one, there's a duty to act or not to act. Okay. So yeah, you should have pulled your property out of the building. Did you breach that duty? Yeah, you didn't do anything. You watched it burn. Did you suffer losses? Yes, you did. Okay. Bodily injury or property damage. And all of that's related to proximate cause. Now, proximate cause is when you have an uninterrupted chain of events from the negligence leading to the loss. Okay. So you have to have that uninterrupted chain of events. Now, that's a different definition from occurrence. Occurrence is more in liability coverage, is defined as continuous and repeated exposure to the same general harmful conditions, like a one-time event, like an accident. Okay. If you are on my website studying my sample test questions, I have a playbook and I have these definitions on there. Okay. And it's in the sections where you'll get the questions at. So, okay, just so you know. A tortfeasor is someone who commits a tort or someone who is negligent. You might get that. I haven't seen it in a lot of the study materials from other companies that provide the required hours that you need to do, but it's popped up a couple times on the test, multiple tests in different areas. So tortfeasor is someone who commits a tort or someone who is negligent. All right. Some other tort law items: absolute liability, where the public demands that those engaged in it be held responsible. This is a form of absolute liability. The best example I can give you on this would be workers' compensation. If you are an employer and you have one employee, even if they're part-time employee, you are required by law to provide workers' compensation benefits for that employee. That's medical, income, death, and rehab for that employee. You are absolutely liable to provide coverage for them. Okay, so that's kind of an example of how that works. Whenever you see strict liability, think of manufacturers. So we have a toy manufacturer. They manufacture this unique toy. They sell it at Toys R Us, well, hopefully before they go bankrupt. And you buy it and you take it home, and 2 years later, it malfunctions and stabs your kid in the leg. You're not going to sue Toys R Us. They didn't make the toy. You're going to go directly to the manufacturer and sue them for their defective product. That's what we call strict liability. Think of manufacturer defect. Okay. Negligence. Areas of negligence where we have contributory versus comparative. Whenever you see contributory, that means if you contributed in any way, shape, or form to the loss, you get nothing. Okay. So two people back out of a parking lot at the mall at the same time and they both bump each other. They both contributed to the loss. Under contributory negligence, neither one can collect from the other party. Okay, because they both contributed to it. Early pre-workers comp law, we had contributory negligence. That was one way the employers would never have to pay a claim, because if they can prove that the employee was responsible in some way, shape, or form, even to 2% or 1% towards that loss, then they contributed to the loss and could not collect workers' compensation benefits. Okay. That eventually got replaced by comparative negligence, where if you are partially responsible, you can still collect partial damages. That means if you contributed 40% towards a loss, you could still collect the other 60% from the other party. Okay. So when you see comparative, think we're sharing in the claim. Gross negligence, look for total disregard for authority, willful or intentional. Okay. Like your fifth DUI. So not only fifth, geez, man, you were fined, you've been to jail, and everyone at AA, and you do it again where someone is injured or dies. That would be gross negligence. Okay. Vicarious liability is where you are responsible for the actions of another. It's very common that parents are responsible for the actions of their children. Okay. And employers are responsible for the actions of their employees. Right? So if your employee injures the customer, you, the employer, could be held responsible, and that's vicarious liability. Okay. Assumption of risk is more of a defense. Okay. You know that when you go skydiving, that chute may not open or may not open properly, and you can plummet to your death. I mean, you know that, yet you still want to do it. Well, great, sign this waiver, and you assume the risk. That means if that chute doesn't open, and you plummet to your death, you don't have any recourse to sue us for that. Okay. So again, where the risk is known, and the person still wants to engage in the high risk activity, that's assumption of risk. Okay. Another way old pre workers comp type or early workers comp law rule would fellow servant rule. This is another way that your employers got out of paying claims in workers comp. Okay? Anytime that your employer could blame your coworker that you for your loss, then the employer would never have to pay. Okay. So, maybe your coworker left a shovel and you didn't see where you're going, you tripped over, you fell down, hurt yourself, and broke your leg. The employer wouldn't have to pay because that was your coworker's fault. Okay, they called them fellow servants back then. Okay, now fellow servant rule really doesn't apply today. Contributory negligence in most cases does not apply anymore. Okay, but these are some definitions that you may get on your exam that you want to watch out for. All right. Damage awards. All right. So if a loss is suffered, we have specific. All right. And whenever you see specific, it means there's a specific dollar amount to the loss. That means if you ding your fender, I know exactly what it would cost to bang out the dent and paint it, or replace the fender with another fender, which includes labor costs. So I know exactly what to pay. That's specific. As part of specific damages is special damages. For the exam, whenever you see special damages, that would be lost wages or lost income. Okay, so because of this, you could not work for 2 weeks, and so that would be special damages, which could be awarded where we're going to pay you the missing lost income that you had. Okay, general damages would be the non-specific. Mental anguish, pain, and suffering. That's non-specific. I mean, how much would it really cost to make you feel better? Let me explain. This is a horrible case. It was quite a few years ago, where this guy's he's got his I think it's like a 2-month-old baby in his arms, and this guy on a bicycle riding by took a gun and took shots at him. Hit the dad in the shoulder, hit the kid, killed his baby in his arms. So even though you catch this guy on a bike who's doing this ride-by shooting, even though you catch him and you sue him, how much money would it take for you to feel better you lost your kid? You see what I mean? So that's that non-specific. Okay, it's probably an extreme case, but it makes impact. To me, I can't even believe stuff like that exists, but it does, unfortunately. Okay, but that's general or non-specific losses: mental anguish, pain, and suffering. Okay. Punitive damages is where there's a monetary penalty, and they're setting an example for the industry that if this ever happens to your establishment, you might have to pay this. So let's go back several years ago. Some of you probably remember the story of Stella in the McDonald's drive-through. When they first came out with their coffee, Stella ordered some of the coffee. Hmm. The drive-through cashier hands the coffee to the window, and usually when they hand it, they have the cup around the side. Well, Stella grabbed the cup around the top, around the where the lid area was, started bringing it over, and the cup dropped out from under the lid and dropped into her lap, giving her second third-degree burns. All right. And in the lawsuit, that what we saw is little old lady sues McDonald's for $2 to $3 million, for injury because she spilled hot coffee on her lap. Okay, um, the medical bills wasn't that much, not that high. It was a bit, but not that much. But they threw the $2 million in punitive damages to set an example to the fast food industry that if this ever happens in your establishment, this is what you might have to pay out on a claim, and so you need to take steps to keep this from happening ever again. So what McDonald's did is, number one, they turned the temperatures of their coffee down, and number two, they also have warnings everywhere. Caution: our hot drinks are served hot, so be careful with it. So giving disclaimers, disclosures for everybody. Okay, that's what that's about. Okay. Now, if you have a discrepancy with the insurance company about how much is paid on a claim, if it's liability, then you go through arbitration. Okay. So you pick an arbitrator, the insurance company picks an arbitrator. These two arbitrators pick a third arbitrator that hears both sides and makes an ultimate decision. It is binding. Once you agree to arbitration, the decision is final. There's no appealing. Right? So remember, for liability disputes, you go through arbitration. But for property disputes, well, now you pick an appraiser because they have to appraise the damage to the property. Okay. You pick an appraiser, the insurance company picks an appraiser. These two appraisers pick an umpire. And they plead their case to the umpire. The umpire makes the ultimate decision. And again, the final decision is binding. There's no appealing here. Okay. But this is if you have a dispute with an insurance company on a claim. This is the process. Right? You can actually forego this and sue. Good luck with that. Okay, but it's a very lengthy course. Arbitration appraisal is more, cost effective and a quicker resolution of a dispute. Okay, so at this point in time, we kind of completed the material, so I'm going to open up for questions. If you have not registered and considering registering, here go to LGD Study. All right, click on the course you want and sign up. You can use any credit card. You don't have to have PayPal. All right, and so I'm going to now open this up to questions.